Welcome to Markets Now. I'm Michelle Rook with Mike Zuzulo, Global Commodity Analytics. Mixed closes in both grain and livestock futures on Friday. Let's unpack this thing. First of all, the soybean market saw a pretty decent rally on Friday. Was the market trying to trade a little bit of optimism about pulling back tariffs with China on the weekend?
Yeah, I found it a very interesting week overall. Friday, no different, Michelle, when it came to the soybeans gaining on the corn in a big way. And, as we look at it from essentially March 30th to the current price action on Friday's close, beans have continued to gain while corn has continued to weaken. Two reasons, I think, for that. The trade's working away from the demand spread. Buy corn, sell beans, as we were nervous about the tariffs with China. As you rightfully point out, this meeting on Saturday, a big deal because President Trump talked about Friday maybe taking the tariffs down to 80% for China versus the 145. So what does that mean if we do that in terms of what China takes their tariffs down for the United States?
So let me follow up on the China trade negotiations that are going to happen this weekend. Trump said they might go down to 80% on tariffs, but China wants zero. Do you think that they're going to walk away with this a disappointment? We know they're not going to get a trade deal, obviously.
I've told clients and subscribers very plainly, I'm very nervous that the U.S.-China trade relationship is going to stay tough until the end of this calendar year because both sides feel deeply entrenched in what they believe. This is why India is so important. If you want a new commodity super cycle, you want a low in commodity demand, get a big trade deal with India, especially when it comes to biofuels and ethanol. I think that would be a game changer to the trade sentiment. And it really, I think, would take pressure off the U.S.-China relationship.
Do you get a sense we're going to get that India agreement or at least the framework fairly soon?
I've heard that from more than one corner this past week, Michelle. Really good sources suggesting that. I'll be watching the news very closely. I think it's extra important because it seems as though the Asian sources I talk to and look at are suggesting both South Korea and Japan are going to be put off, maybe all the way into early June. I think the trade at the end of this past week really told me by its trade action, with the soybeans being a key element of distinction, that we need an Asian trade deal. UK is good, but we need an Asian trade deal. No more talk at this point.
So corn was to the plus side on Friday as well. Did corn follow soybeans, or did we just see some short covering after making new lows for the move?
I think both. I think one of the things that the corn market doesn't really want to look at Friday's close with the report right around the corner was the idea of what does the 25-26 export demand look like. I think instead the Newswire estimates came out early midweek, and I was surprised, I guess, that the average trade guess for ending stocks for soybeans was not much more than 350 million bushels. That doesn't reflect really what the range is. It's all the way from 275-ish all the way up to 675. You've got a 400 million bushel difference between low to high on the soybean range. That 370 or 360 carryover number looked a lot more appealing, I think, to the trade than the 2 billion bushel average number that the Newswires, Reuters specifically, were carrying when the estimates were released.
So, Mike, though, if you look at the average trade estimates, and if we consider USDA is going to use tariff considerations to maybe factor in what's going to happen with demand down the road, could 375 and 2 billion bushels be too low?
I think the 375 is way too low. I'm at a 577, Michelle. That's with a 50 bushel yield plus. And I took exports down about 25% from the 24-25 marketing year. You could go 40-50% because that's what we sell to China of our total in many marketing years. So that was the oddball thing on Friday's close, quite frankly, is we bought beans and sold corn. We took the no bean corn ratio up to 2.34, 2.35 area, highest since November of 2024, with this report looming that could be saying the exact opposite when it comes to the carryover level. So I think the trade's got it right with about a 2 billion bushel corn carryover, especially with the UK trade deal and probably some increased exports in ethanol. But the bean number just seems way too low on the estimates to me.
So the old crop corn estimate is just a little over 1.4 billion bushels, 1.43 or something in that nature. Do you think that we're going to see that adjusted? Because right now with what the spreads did this week, it looks like that number might be too low.
Yeah, that's a great question because the answer is, to me, the demand on the export side has not let up at all. In fact, it's increased with 65 plus million bushels of export sales, almost 50% above the 4-week average, and then almost daily sales to Mexico and unknown destinations still for 24-25 marketing year. And that's on top of running about 30% ahead of last year in year-to-date inspections for exports. So I think we could easily pull down the old crop carryover. So why would that be compressing the spread? Well, I don't think it's about the demand. I think the trade has been using that July D's corn spread as a weather market spread, bullish, taking the July higher when we had South American weather. Talked to a Chicago colleague this week, and he said, South American supplies are coming. Why should I be long July? Essentially is what he said. This is a key spread, I think, going into the U.S. weather market, especially with this dry weather in the Western Corn Belt.
The wheat market back down at contract lows here for winter wheat, but the improving weather and conditions and ideas we're going to get bigger yields. Is that all what this is about?
Yeah, I would say the wheat market, if you look at it domestically, with the drought conditions going down a little bit versus the prior week, you could argue, along with some rains in Ukraine, that we don't need to put any weather premium in this market. Globally, though, and this is where the WASDE report comes into play, globally, I think there's some significant issues in China's central wheat that the market's just simply walking past the graveyard. I'd heard that they were buying Canadian, Australian wheat to the tune of 400,000 to 500,000 tons on Friday. I'd heard they've also been in for feed barley from Ukraine, potentially as much as 1 million tons because of the drought that they're feeling in provinces like Henan province. And that, I think, is a big key player along with the Western Corn Belt drought and the Ukrainian weather. Do they get rains to get out of their drought? I think these are issues that could be right back in front of the market in 20, 30 days from now.
Yeah, we do not have any weather premium really in any of these markets. It doesn't look like.
No.
Okay, so cattle market, more new contract highs here today in live and feeder cattle futures, and then we saw some profit taking in a bull market.
Yeah, and I'm still on track with the idea. I told clients about a week and a half ago, if there's one thing I want to do before the WASDE report, it's sell cattle on new highs and sell beans if we rally. I'm still in that camp, Michelle. And I say that about cattle because we're getting to prices in the second quarter when we get into summer grilling season that I'm not too excited about, that we probably need to get some protection in place. But this past week really showed us Wall Street still matters. When it came back up at the end of last week and then followed through this past week, it really did help, I think, bring the funds back into play. Feeder cattle came back as well. Feeders are back leading the fats. That's what happened in 2014. Feeders also made the highs first by a couple weeks. And by the end of the month of October of 2014, feeders had closed on a new monthly low. That was an early indication the fat cattle high was just about in.
But cash is king on the live cattle side or on the fed cattle side of things, more record cash prices here. And so until that cools and the packers quit chasing after that market, that's going to have to stay strong for a little while longer, isn't it?
Yeah, I think that's a really good point. You've got the funds and their managed money longs. Do they get back up to a record net long position? That's a box that I want to see checked before thinking the high could be close. Packer break-evens are the other thing. We got down to around $200 a head negative, I think back around February, early March. That's a target price for us to get back down to check another box. We're probably running and pushing on a string at this point as far as taking highs to new levels. Tyson earnings were very important to me because prices went up 8%. Their volume sales of beef went down. They also said what I think is going on and have been talking about for a couple months. Retention has started. So I think that's another early indication that the cattle market's getting long in the tooth for this rally.
Okay. What about the hog market? Is it all about China there?
I think it is. And I think this is one of the things that is going to be important, like Wall Street with the cattle market. If you want new highs in the cattle, you've got to get the hogs on your side because that cattle hog spread is getting into the stratosphere at this point. But yeah, the pork and bean trade really was active this past week. Up beans, up hogs. That's my China trade.
That is. So this weekend's negotiations are going to be super important, aren't they?
They really are. And if we don't get an Indian trade deal, I would lean towards a more bearish outlook on the WASDE report, especially if we don't get any good news from China either.
Gotcha. All right. Thanks so much. Mike Zuzulo with Global Commodity Analytics. That is Markets Now.